welcome. Hope you guys are finding yourselves well. My name is Ryan Stone. I'm the Prosperity Professor. I'm joined here with Rasool, CRE. He is a real estate mogul taking off and helping tons of people give back, and that's what we're all about. I wanted to talk to Rasool today because he made a great post the other day about a cash flow strategy and how to finance a big liability he needed for his family, but in a creative way, and keeping the most amount of cash flow and wealth in his family. And that's what I'm all about. So I wanted to take some time, interview Rasool, talk to him about this strategy that he developed for himself so that we could share this and also point out some finer points and context around it. So if you're all about building wealth, growing your money, growing your assets for your family, you're going to love this video. Rasool, tell me what we're talking about today.
Awesome. Yeah, thanks so much for having me, Ryan, man. And I'm glad you approached me about making this video explaining what it was that I was doing with my family. So to give you guys a little bit of context, I've got kids, 2 right now. I've got another one on the way. My wife pregnant, and our family is growing. And right now the Tesla is not cutting it. We have a sedan, a Model S, and we tried to put 3 car seats back there, and it was a nightmare. My wife was all scrunched up on the front. I refused to go move my seat forward. So we're like, all right, we need another option. And for me, really active with my kids. I've always had the dream of having a minivan. Laugh, get it out all you want. That's my dream. I want a minivan. If you live in America, you know there's 3 main options that you have when it comes to minivans. You got the Honda Odyssey, Toyota Sienna, and the Chrysler Pacifica. Right off the bat, I know that I'm going to be putting in tons and tons of miles. We have family in Orlando. We go back and forth, Disney all the time. So fuel efficiency was our number one concern, especially coming from a Tesla. I haven't been to a gas station in like 2 years. So the Honda Odyssey was out. They don't build any kind of hybrids, no electric version, anything like that. The Chrysler has the plug-in hybrid option, and all Toyota Siennas are hybrids. Now I'm in this for the long term. I want a vehicle to be reliable, long term. I'm going to ask you guys right now, if you had to go for a reliable long-term vehicle, are you going to choose Toyota or are you going to choose Chrysler? Right? Hands down, everybody knows Chrysler is going to be found dead on the side of the road and everything like that. So, and let me preface this conversation with, normally when I buy vehicles, I always stress to people how important, how much more financial, economical sense it makes to go and buy a used vehicle first. But the thing about Toyota Siennas that I found out is used Siennas are going for almost as much as brand new ones. I looked at a 2021 Toyota Sienna. It's like 3 years old at this point. It's got 25,000 miles on it, and they were selling it for $39K. A brand new one is $45. And I was like, I'm not going to go through that. If I wanted to find something else, what I normally buy, like $15,000, $20,000, just buy it in cash and leave it alone. I'm looking at a van that's probably built in 2013, has over 100,000 miles on it. And that is something, at this point in my life, I don't need to continue sacrificing. I've already done a lot of sacrificing. I've built up a lot of assets and everything. For us, this is just, hey, what's the most optimal way for us to buy it? So we had a number of options. We've got cash. We could just buy it off outright and not have to worry about having a $1,000 a month payment. We had the option of financing it. And our other option that we were looking at is why, Ryan's on here. If you watch any of his content, we are practitioners of the infinite banking concept. And so we looked at a lot of the different options. Oh yeah, we've got this whiteboard here. We were hashing out different ways to finance it, right? And so I want you guys, if you're new to these concepts of how to be able to purchase vehicles, how to utilize and leverage your cash and everything like that, there's these 4 ways. Why'd you tell them about the 4 ways and how that works, right?
Yeah, I mean, there's really only 4 ways to finance something like this. There's the saver method, as you said. This person starts at 0, starts putting money away every month or year, and eventually gets to a high point, spends that money, goes back down to 0, but now you have that liability or asset, right? Yep. That's kind of the typical method. The other way that I think is way more popular in America is the debtor. We have an insane amount of consumer debt. I think it's in the trillions now. Yeah. We love our buy now, pay later methods here in the States. So the debtor does the same thing. He starts at 0, goes into debt for the loan, and then slowly pays it back over time.
The interesting thing about both of these guys is at the end of their journey, they both end up in the same place of $0.
Right. But you have the thing. You got the Sienna, right?
Yeah.
What the infinite banking concept teaches is, instead of utilizing your savings out of your bank where now you're no longer collecting interest on that money, or loaning your money from a debtor where you don't have any control over that loan. You have to make the payments. It's dependent on your credit. What the infinite banking practitioners believe in is I'm going to create my own asset from which I can bank from. And a lot of people get hung up, well, I'm going to take a loan on my money. That's kind of weird. You're actually not taking a loan from your money. You're taking a loan on your money. And you want to do that because what that allows you to do is, as you can see in the picture, we take that debt, we take that loan, we're paying it back slowly. But because we didn't pull our money out, it's still growing inside the policy. And so once that loan is repaid, at any schedule you want, because you're in full control over the terms, you don't end up back at zero. You actually end up higher than you were when you started out. So now you have the asset or the liability and more in savings within something that's going to do a lot more for you than just a bank account.
And tell us about that fourth option.
The fourth option, I think, has been around for ages, but I think it's becoming more and more popular in mainstream America. And that's the idea of not buying the liabilities outright, but buying assets that can then pay for those liabilities or other assets.
Yeah.
And Rasool, I really wanted, after I heard you did this, I really wanted to schedule this time to talk because you really mixed, you and your wife kind of mixed the infinite banking method and the asset manager in a really beautiful way. We drew the picture. Why don't you walk us through what you actually did?
For sure. And I actually even leveraged the debtor portion as well because—
You did all three, that's right.
I used all three. And even though I could have just used the cash, I like having a good amount of cash beyond my nest egg, my emergency savings and everything like that. And the reason being is because in this particular time in the market, there's a lot of volatility. I'm a real estate investor, and I've been noticing that there are like foreclosures increasing. I think there's a lot of stress with the financial markets and whatnot. All of these things are reasons why I want to sit more in liquidity, and I don't necessarily want to give that up for a van that's going to depreciate over time. So that's the number one thing, right? So I want to preserve the cash. Paying the car off in cash was an option. We considered it. We don't want to do that. So we were able to go to a local credit union, right? Because bank financing is more expensive these days. But we got a loan for $50K for the vehicle, 4.25. That was the first piece. So
that bought the car.
That bought the car. So that $50K goes to the dealership. I now have an agreement with the credit union to pay them back over 5 years to pay that off. It's about $1,000 a month. The second thing that we wanted to do is leverage our life insurance policy. Now, the reason behind that is, like I said, as a real estate investor, I am invested heavily into a market where I am actually able to buy some real estate properties for this $70,000. And that is costing me 5% that I'm borrowing against it. And it's going to take these 2 single family homes that I'm purchasing. And I'm buying these outright, by the way. In this market in middle America, I provide a lot of affordable housing. You can see the rents are very cheap. I live in Miami. My neighbors across the street, they rent their house for $6,000 a month. Thank God I bought this in 2019 before all this happened. And that's the idea. That's the premise. We have our IBC, or infinite banking policy, that has a high balance in there at this point over the number of years that we built it. So we only took a loan of $70,000. We used $70,000 out of that, and we paid for these 2 single family homes. Literally in process right now, waiting for the transfer to happen. And once that cash comes, then this property is already rented out. And then this property is going to be rented out. Actually, yeah, it's rented out now. They started on the 1st of September. And so I'm going to get a prorated amount for that. But this house is going to bring $600. This house is going to bring $700 after expenses. So I'll have $1,300 in cash flow from that $70K. So just from an ROI perspective, right? If I would have used let's just say I paid $70K for the vehicle, I could have saved myself $1,000 a month, and that would have been $12,000 a year. And divide that by the $70K, that's a 17% return on my money for the next 5 years. Not bad. That's actually a great return. Anything that's like over 15%, I'm game. But by doing the properties, I'm able to get the $1,300 a month, which comes out to $15,600. Divide that by the $70,000, and I'm making 22% on my money. That's my ROI. Now, the cash flow from these assets that I purchased are going to pay off my loan of 1023, and then the remainder is going to go towards paying back that policy loan. It's not going to make a huge dent in it, but it's just going to slowly dig it out, and it's automated for me because I've got my property management in there. Anytime I have somebody move out, of all the rentals I've had one move out so far, and that person was replaced literally the following month.
Also, we should share, I forgot to mention, for those that don't know Rasool, he went from 3 doors in his portfolio to almost 4,000 in 3.5 years. So
a minor detail.
Yeah, we're talking about a lot of doors here. So to have that kind of persistency is saying something about how you manage properties.
Yeah, absolutely. And I want people to understand too. You'll see here that I'm buying single family homes. There are a number of facets to my portfolio. So my commercial properties are for the big chunks of wealth and net worth. I get multiple 6-figure payouts whenever these properties refinance or they sell. That's how that part works. And from my perspective, I don't want to live off of that money. And so I want to take, whenever I get those windfalls, I reinvest and I buy more property. That's all it is. And money comes back, I send it out to go work and multiply and everything like that. These single family homes are what I call my lifestyle money. And so I buy these with zero risk because I don't take debt on these properties. I like to build up enough cash and then just pay these properties off. Build up more cash flow and pay these properties off. So I incrementally increase my monthly income every single time I piecemeal more of these properties together. So the single family properties are my cash flow machines. And then the large apartment buildings are my net worth growth machines, right? And all of that goes to funding my IBC that allows me to be my own bank so that I can do options like this. When I went to go get this loan, it was literally, I made a video on it. I probably should have just made it a reel. It was so short. I logged into my portal, entered the amount of money that I wanted, and then I just hit send, enter. And then they said, okay, your money's gonna be there Friday. No questions, no credit pull, no nothing like that. When I went to the bank to get this loan, I was there for hours and they pulled my credit and they dinged me. I went from 850 to 848, breaking my balls here.
Yeah, oh no.
I don't know what I'm gonna do now. But that's crazy though, an 848 and I still have to pay 4.25. You know, the heyday of those 1%, 2% loans from 2020 and 2021 are probably never to be seen again.
Yeah, those are like giants.
But that's ultimately what we decided that we wanted to do. That's like, hey, we sat down, my wife and I was like, well, these are our options. What do you think? And we're like, well, if we leverage our IBC to purchase assets that will produce cash flow that will more than cover our debt on the vehicle, then it would make sense for us to be able to do that. Because if I would have just taken this loan at the end of that 5 years, I would have just paid, probably about $62,000 or $60,000 with interest and everything else like that. And then I would have had a vehicle that's worth maybe $35,000. So I would have paid an extra $7K to lose $15K. But in this way, these properties we pay for $70,000 are going to appreciate over time. Hopefully in 5 years, maybe they're worth $100,000.
There's a weird coincidence of numbers. I don't know if you caught it, but what option one, the debtor way, paid for $22,000 in payments and fees, or the IBC plus asset manager method, you're actually going to make 22% on your money, which is a weird coincidence. It's kind of weird.
And then, so not only is my balance in my IBC going to be going up, my liquidity in here, but also this home is going to be worth more and this home is going to be worth more. And so, and for you guys, you might be asking, okay, well, I took a loan here and I took a loan here and I'm using the proceeds here to pay back this loan. What about this loan? How is that one going to be paid off? So, like I said, I have more properties in this market. And once I complete, I'm working on 6 renovations right now. Once all of those are complete, I'm going to take out a loan against those properties and pay this off, whatever the balance is going to be. If I even need to, because by the time that's done, I might actually cash flow enough to pay this off within that first year or two.
Yeah, here's the thing, and this may be helpful to impart some more context on the life policy loan.
I don't have to pay it.
Yeah, exactly. Notice how Rasool is flipping back and forth on his repayment terms to himself. That's the beauty of becoming your own bank, is that you have full control over that repayment schedule at all times. The life insurance company is never going to chase you for for that loan. It does not affect your credit. It doesn't even show up on reports. It's not taxable. It's not even tax reportable.
I almost believe they want you to default on that loan as much as possible.
Yeah,
because that way they're not on the hook for the face value of that policy anymore.
It's the face value minus your outstanding loan.
Well, I mean, if you default on it and then it eats up all your cash value and then your policy's gone. I'm saying worst case scenario and everything that's like really, really bad. You're in super dire straits at that point. You need
most policies right now have an overloan protection rider, so you can't even do that.
Oh my goodness.
Yeah, they won't let you take a loan out that will lapse the policy.
Ooh, that's good to know.
Yeah.
I never worried about that spectrum of the financial chain. I'm just like, okay, how can I get ahead faster? And what other tools do I have at my disposal? And and looking at these types of things, it's just amazing. So I still remember back when I had graduated college, I was a life insurance agent. I don't know if I told you that in the past. And I was on a commission schedule. I was 26 years old or something like that. And I went to Mazda to try to buy an RX-8, and I got denied on a $26,000 vehicle back in the day. So I didn't understand anything about finances and proving income and all sorts of stuff. And so it was probably the best thing for me to get denied then and there, because if they would have let me into that with what I had going on, man, I would have been in a really rough spot.
You would have looked cool doing it.
That's true. And it was stick shift. I stalled twice on the demo because I didn't know how to drive stick.
My dad had an RX-7. It's sweet. So just because I know we're going to share this video with your members, and I know the members of Soul School and Rasool CRE, like they're really knowledgeable in the asset management side. What questions do you think they may have around utilizing life insurance or like when someone should get it? What have you heard any blurb about it in the group?
Yeah, absolutely. I've had a number of people. I've sent them over to you as referrals, as people who are looking to get started with their banks. And when I did a mini presentation within my group, just because people were asking about it, one of the most recurring questions that they get is, what is the best way for them to start? Should they do lump sums into their policy? Should they fund it with premiums? What would you say as the expert, Ryan? Like how does somebody who doesn't have one of these get into their first one?
Yeah. So for me, it's like all of the above. It really depends on the person, 100%. Let me give you like a couple mind frames that I have around buying these policies and financing them. For me, like one of my favorite ways to do it is very similar to what you did here, where you actually have other assets financing this asset for you. Like maybe you already have some rentals where there's cash flow coming off of those, or maybe you have a high interest debt payment already somewhere and you're already paying off that debt. There's ways to install the life insurance policy right in the middle of your existing cash flow thoroughfare, and you can instantly start using it and building up that internal arbitrage. Another couple rules of thumb is like, I don't know, there's some people out there that just say, hey, take 10% of your income and put it towards permanent life insurance, and you're going to thank yourself later one day.
Yeah, now, if it's properly structured.
Yeah. We want to look for mutual companies where you're a partial owner of the company. There's no stockholders. You're getting 100% of the dividend. The company has loan provisions that are favorable for you. The structure itself, you understand how much is going to the base premium versus the PUA. If that's Chinese to you, come talk to me and I'll explain it.
Paid up additions.
Yeah, there's all kinds of variables there that are good and bad depending on each individual. It really is as unique as that. But here's something I'll stand on till the end of the world. Nobody in this world will reach their maximum economic potential, the most they could ever make for them and their family. Nobody will reach that point if you're dead. So life insurance alone is not going to do it for you. That's why I kind of cringe when I see some of my peers saying like, you need to stop your 401k and buy an IUL. It's like, dude, no, like there's not one financial vehicle that'll take anybody all the way.
Yeah.
However, this is what I would stand on, and I would debate this on national television just simply because of the thousands of calculations I've done around this. Nobody can reach their maximum economic potential without the proper acquisition of permanent life insurance because of what it does and how it can be added on to anything else you're doing. So like a really simple rule of thumb is if you're looking to get involved in this, think about it kind of like buying a jacket. You ever buy a nice suit? When you went to buy a nice suit, you didn't buy like the top of the line the very first time, right? You just kind of like bought a jacket, you bought something nice, something that you can eat out in.
I got 5 suits for $500.
There you go, right? Buy the suit that's going to work for you. Try it on, use it a little bit, try and break it. And if you like it, then go a little bit harder. But it's better to start small and kind of work your way up. But it's a phenomenal asset. It's incredibly versatile. It's very diverse as long as you're getting it set up by someone who can really look under your financial hood and show you where you're going to get the best value in implementing this.
Yeah, man. I think on our next talk, we should talk about leveraging the IBC to pay off your 30-year mortgage in 7 years or less.
Yeah, it's a great strategy. If you're in the home that you love, you're not moving, you want to keep it for generations to come, knocking out that debt and retaining 100% of your mortgage balance in your own personal economy is super, super powerful.
Oh, yeah. Yeah. So, man, what else do you think? Are we missing anything that maybe we should cover?
Pretty cool.
Yeah, it's a pretty straightforward concept. I mean, not too straightforward. It's a little bit, it takes a little bit to understand, but I mean, look at step number one. I got a loan from a credit union. Step number two, I tapped into my own personal bank. And then step number three was leverage my skill in real estate to go ahead and buy these assets. And that's really what it is. The cash flow from the assets are going to pay back both the vehicle loan as a priority and then the life insurance policy loan, because I have more control over that. I would rather have, if I had to have debt in one place over the other, I would prefer to have the loan in my IBC versus having it at a credit union who, for whatever reason, at some point in the fine print, they can call my loan due or repo my vehicle or do something. I don't want to be in that type of situation. So even though the interest rate is lower over here, the value of this asset, I wouldn't even call it an asset, I'll call it a liability. The vehicle is a liability. It's going to go down in value over time, but it's a necessary liability. I need it to transport my family around. And the IBC is my asset that is going to continue to grow for the remainder of our lives.
Two things I'll highlight. This is a bit in the weeds, but even though your life insurance policy is 5% and that looks like a higher interest rate, one thing you may not realize is that life insurance policy loan interest is calculated in arrears, which means that every dollar you repay to that loan goes to the principal first, which is reducing your amount of interest owed in total at the end of the year.
Yeah.
As a car loan is APR, and that interest is compounding every single month on the outstanding balance. So even though it's 4.25%, it's compounding monthly, whereas the life policy loan the balance is going down with every $300 payment, and interest charged on the remaining amount is less.
I need to look at what the date on that calculation for the arrears, because what I'll do is I'll probably just dump all my cash and pay off that loan and then take it back out.
You literally could do that. And another thing you could check, it may be too late for it now, but if you had an illustration from last year on where the cash value was at, and what was illustrated 5-6 years from now, that number, after, let's say you repay the loan, you could take 5 years, 10 years, 20 years to pay back this Sienna loan. The cash value will basically be exactly what it was going to be with or without the loan.
Exactly. Well, I like it.
Pretty cool. Well, that's awesome, Rasool. I think we should be doing these maybe once or twice a month, and just keeps talking about this stuff for people that they're just not in this realm. They're not thinking about these things. And when we're not thinking creatively about how to get through like tough times or good times, then won't have the foresight that you had a few years ago, because the real step one of all of this was buy a life insurance policy years ago, set it up to the best you can, and then get into real estate or things that are going to create a bigger return and bigger wealth for you than just buying life insurance.
Yeah, and I get a lot of people's hesitation or their confusion around it, because again, I was licensed. I had to read a book by Nelson Nash and Pam Yellen to really like wrap my head around how the stuff works, because they were using examples of having a grocery store and what it's like to stock it and fund it. And if you had people, if you were buying your own stuff, you'd put more into it. And I was like, oh. And then the more I read it, the more all I say to you guys, understand it, or even if you don't understand it, just get one started, because it takes time to build it up. Anyway, you're as young and as healthy as you're ever going to be in your life right now, and it's going to give you the best rate to buy more life insurance so that everything is tied to the face value. The more coverage you can get, the bigger you can build your bank. That's what it's going to come down to. And so, yeah, do it when you're young. Be smart about it. Make smart decisions. Buy assets that are going to pay for your liabilities the way that Ryan and myself love to do.
Awesome. Tune in to us next time. Like and subscribe. Follow for more. And we'll see you on the next video.
See you guys.